Financial planning for the second half of your life, 10 key issues. Materials provided by Genesis Financial Management. Age 50, plus or minus 5 to 10 years. We call this financial halftime or intermission. This is when you think about past accomplishments, what one still wants to do, new challenges and decisions, an increased interest in giving something back to others. And many people want to simplify or downsize in this age bracket. Key financial issues that we're going to cover. Financial basics, reducing financial risk, investing decisions and asset allocation, creating retirement paychecks, minimum required distributions, tax planning strategies, transferring untitled personal property, getting help and hiring advisors, leaving a legacy, and communication issues about money. Common financial errors. Changing an investment strategy drastically on a specific date, like your 60th birthday. Forgetting about the effects of inflation. 3.5% inflation will double cost in about 20 years. Relying too heavily on financial salespeople. Assuming that estate planning is just for the rich. Retiring without considering health coverage. Not planning for long-term care expenses. Improper asset withdrawals. Number 1, don't forget the basics. Cash flow statement. It's a summary of your income and expenses. Net worth statement. A summary of your assets and debts. Specific financial goals, which should include a date and a cost. And an emergency reserve. 2. Assess current and future insurance needs, like life insurance, disability insurance, health insurance, long-term care insurance, the amount and length of coverage, the elimination period, age at purchase, and health status. Umbrella liability. Follow recommended investment strategies. Don't invest if you don't understand. Diversify different assets and types. Invest for long-term goals, 5 years or more. Have reasonable expectations. Buy low-cost investments. Don't pay attention to the market noise. Balance risk and reward. All investments have some type of risk. Ownership versus loanership. Ownership investments have variable annuities, are stocks, real estate, REITs, growth mutual funds. Loanership investments are fixed annuities, corporate bonds, government bonds, Ginnie Maes, money market mutual funds, CDs, U.S. savings bonds. Number 4, create a retirement paycheck. Try to simulate a regular income stream, annual cash withdrawals, automated monthly fund withdrawals, laddered bonds or CDs, post-retirement employees, earning limit under $12,960. Keep tax-deferred investments and Roth IRAs growing as long as possible. How much can you take out? First, draft a budget before you start spending. Always keep an eye on inflation. There are 2 key factors that determine how long your savings will last: your withdrawal rate and the rate of return on your investments. If you roll your retirement assets into an annuity, the insurance company you purchase it from is charged with figuring out the withdrawal rate that's actuarially sound for the firm and that will meet your required minimum distribution once you're 70 and a half. However, if you delegate the income payout process to a professional, if you set up a systematic withdrawal plan with an investment company, or if you manage your portfolio and create your own paycheck, the rate at which you decide to take money from your savings in the form of retirement income is one of the 2 factors that will determine how long your savings will last. Withdrawal rate consensus. It's between 4 and 5%. Many financial advisors believe the withdrawal rate should be somewhere between 4 and 5%. It can be increased by the rate of inflation annually. What you should do depends on 3 factors: your expected investment returns, whether or not you want to leave money to your heirs, and whose statistics you believe the most. Some advisors conclude that the best way to increase the probability that you won't outlive your retirement savings is to keep a heavy weighting of stocks in your portfolio, between 50 and 70% of your assets, and keep your withdrawal rates between 4 and 5%. However, this fails to address the real impact of market volatility. If you have 70% of your assets invested in the stock market and it takes a big dive in the early years of your retirement, even a 4% withdrawal strategy can have a devastating impact on your account. A spending cutback is in order. In an ideal world, your investment recovers as the market rebounds. However, because you're taking money out of your account at a regular pace, that leaves fewer and fewer dollars. Money that's gone never has a chance to rebound. Suggested investment strategy for seniors. Set aside enough money to pay uncovered excess expenses for 3 to 5 years in a money market fund. Consider the following strategy. Start by figuring out how much money you'll need from your portfolio during the next 3 to 4 years. After taking into account Social Security and any pension you receive, put this spending money in a money market fund. Then split the rest of your portfolio between a mix of stocks and bonds. If the stocks and bonds take a dive, don't sell anything. Instead, wait for the markets to recover. With 3 to 4 years of living expenses in a money fund, you could sit tight through an awfully long bear market without selling any securities at a fire sale price. The remainder grows in a stock and bond funds. Sell shares every year and add to the MMF. If the stock market tumbles, hang tough, tap bonds, and take capital gains and dividends first. Number 5, take minimum required distributions. This applies to distributions from traditional IRAs, Roth IRAs are tax-free, and 401ks, 403bs, or TSAs and SEPs. The distributions must begin by April 1st of the year following your 70-and-a-half birthday. So let's say your 70th birthday was on January 3rd, 2015. But when you turn 70-and-a-half, it's actually going to be July 3rd, 2015. So the distributions would begin by April 1st of 2016. Employer plans, they can delay to April 1st of the year after one retires. How much to take out? The required minimum distribution. So your required minimum distribution is the balance on December 31st the prior year divided by your life expectancy. Failure to take the required minimum distribution. 50% of the required distribution must match or exceed the required minimum distribution. Plan custodian will report numbers. Uniform table automatically recalculates life expectancy. Separate the table if your spouse is less than 10 years younger. Number 6, practice tax avoidance. Make sure to have tax-deferred investments, such as employer salary reduction plans, IRAs, annuities. Look for the low expense providers. Or you can do the age 50 plus catch-up contribution. Or you can LT capital gain on investment profits. And always remember to keep good financial records. Make sure that you have a good tax preparer that can help you go through a good template. Number 7, consider untitled property transfers. Consider interests of the family members. So, which family member likes coin collection or antique cars? Make a written list of property and heirs. Share the list with family and executor. Consider lifetime gifting of property. Annual gift tax exclusion is $12,000 per donation. And you can transfer unlimited amount of property to charity without tax liability. Number 8, get help when needed. It's recommended that you have a CPA when receiving a lump sum distribution. Here are some financial planners. Go prepared and reduce time and fees. Bring financial statements and a list of goals. Number 9, leave a legacy and give something back. Many ways to leave a legacy. You can leave it to your children or your grandchildren. Any creative works, volunteer time helping others, charitable gifting, outright gifts of cash, property, securities, charitable trusts, testamentary gifts via one's will. Less than 6% of Americans include charities in their estate plans. 10. Communicate, communicate, communicate. Talk with your executor or contingent executor. Prepare and share a financial notebook. Discuss burial wishes. Discuss living will issues with proxy. Prepare letter of last instructions. Discuss or list personal property bequests. Questions, comments, experiences? To speak with one of our certified personal financial counselors, call us at 877-202-9246 or visit us at www.yourgfm.org. Special thanks to Barbara O'Neill and the Rutgers Cooperative Extension.